But I think one of the big opportunities is the accelerated depreciation first year expensing that was made permanent under the One Big Beautiful Bill. And what that does is if you build a building or buy a new one, you can take that building, which is usually a long-term asset, but it's really not one thing. There's a bunch of systems. Like if it's an apartment building, there's carpet and HVACs and appliances, and those all have shorter lives to them than the actual structure of the building. So you can depreciate them over shorter schedules. And under the One Big Beautiful Bill, all that short-lived properties you can write off in the first year. So on an apartment building, you might be able to write off 15 to 25% of the purchase price and claim a deduction on your taxes. And if you're an active real estate professional, you can use that against a lot of different income. And so that's a really powerful tool for that in-service bonus depreciation that is now permanent. So that's a tip that I think a lot of people aren't aware of or they don't know how to use it, but
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? Scott Kidd, the Yacht Captain Investor Podcast. Today I have Dwight Dunton on with Bonaventure. How you doing today, Dwight?
I am so great. I can't wait to go on a cruise with you, Captain.
Oh, it'd be great, man. It's a beautiful day in South Florida here. But for those that don't know who you are, just tell us a brief intro about yourself.
Yeah, well, I live in Alexandria, Virginia. I've got 4 kids, wonderful wife, and a dog named Lando, named after the Formula One world champion Lando Norris. So that's me personally. Professionally, I am probably the 3rd generation multifamily real estate investor. Our family got into it in the 60s. And then in 2000, I started Bonaventure with the goal of helping our family continue to build long-term generational wealth. And that has just grown wildly. We manage about $3 billion of assets in multifamily and senior housing. And we now work with about 500 families, helping them build long-term wealth so that they can afford their future dreams, whatever those are.
Nice. Very nice.
Yeah.
Sounds like you guys have had a long, steady road with a lot of ups and downs because it is real estate and business anyway. They go through the cycles.
I mean, what I've discovered is the only get-rich-quick strategy in real estate is to plan to do it slowly. Because if you try to do it quickly, you're likely to just strike out. And I think that that's really been the lesson over seeing 3 or 4 real estate cycles is you just got to get to the other side of the downturn. And generally, real estate has moved up and to the right. And that's been the key lesson of long-term enduring wealth building is you can't get wiped out in the bottom of the cycle.
Yeah, there's really, there's no get-rich-quick scheme really in anything. Anybody that tries to tell you that, they're probably just trying to sell you something, some package or something, some podcast or some kind of thing. Because I know, especially there's a lot of those YouTube gurus that this is the way, that's the way, But I know that the guys that made it, it's like yourself, tried and true, the same fundamentals over and over and over again.
Yeah, absolutely.
What would you say is one thing that sets you apart from all the other operators around?
Yeah. I think that it's really a couple of things because, real estate is really hard to be novel. I would say the couple of things is one, we are the largest investor in our programs. My family and the principals of the firm have about $600 million of our capital invested in our various projects. So we are aligned with our investors. We really think of them as partners and we succeed together. And when we exceed beyond a certain level, we get a profit sharing. So great alignment and we put our money where our mouth is. 2, our platform really is designed to ensure that when our Excel model meets reality, we can actually deal with that. And so our property management, our insurance, our internet services business are all in service of making sure that we get the outcome we wanted when we started the investment, despite the curveballs that get thrown at us along the way. And then the last thing is long-term tax-efficient compounding. Like we have spent, 60 years figuring out how we use all of the wonderful tools provided by the tax code to defer giving our partner, Uncle Sam, their distribution. Yeah. And I think that's the part where so many investors like lose the script and they'll argue over basis points when they have a partner that's entitled to, depending on your state and whether it's long-term or short-term, 25 to 30% of your profits. And people miss that entirely when they're structuring a deal or selecting a partner or making a business decision. Is like, stop quibbling over basis points with the manager and instead focus on how do we not give up 35% of our profits, 25% of our profits to our partner, Uncle Sam. And the tax code provides so many amazing tools in real estate specifically to defer giving them that money and allow that money to continue compounding on behalf of you as the investor and your family. And you just keep trying to push out that day where you give Uncle Sam their share.
Yeah, and that's exactly true. I mean, what would you say, is just one quick tip for somebody just starting out as far as like a little bit of a tax strategy? I know neither of us are tax professionals or CPAs or anything.
Let's get that out there.
Qualify that, the disclaimer that none of us are financial advisors or giving anybody any kind of recommendations. But what has worked for you?
Yeah, well, I'm like you said, I'm not an accountant or an attorney, but I have spent 25 years going to the Holiday Inn Express every night and really learning this as a practitioner. So everything I'm about to share are things that I've picked up over my career. But I think one of the big opportunities is the accelerated depreciation first year expensing that was made permanent under the One Big Beautiful Bill. And what that does is if you build a building or buy a new one, you can take that building, which is usually a long-term asset, but it's really not one thing. There's a bunch of systems. Like if it's an apartment building, there's carpet and HVACs and appliances, and those all have shorter lives to them than the actual structure of the building. So you can depreciate them over shorter schedules. And under the One Big Beautiful Bill, all that short-lived properties you can write off in the first year. So on an apartment building, you might be able to write off 15 to 25% of the purchase price and claim a deduction on your taxes. And if you're an active real estate professional, you can use that against a lot of different income. And so that's a really powerful tool for that in-service bonus depreciation that is now permanent. So that's a tip that I think a lot of people aren't aware of or they don't know how to use it. But being a real estate professional or the short-term rental designation allows you to use that deduction against a lot of different buckets of income besides just the one property.
Yeah, that's a really great advantage. And I try to stay away from calling them loopholes because they're not loopholes. They're really set up as advantages, and everyone can use them. It's not as if only a certain segment of the population can use them.
Scott, I appreciate you saying that. And if I said loophole, I should charge myself a quarter because you're right. They're just the rules. And
if you want to know the one thing that separates investors who win from investors who get wiped out, it's not the deal flow. It's not connections. It's this. Due diligence, not the skim the deck and hope for the best kind. The real due diligence, asking the real questions like who's the sponsor and their team? What is their experience? Does the sponsor have verified exits? What's the downside of the scenario? Are there any hidden fees? If you can't answer these questions and more, you're not really investing. You're speculating or possibly gambling. I built a tool to fix that. It's called the Passive Investor Due Diligence Scorecard. It's free, it's interactive, it's 125 questions across 4 categories. Who is the sponsor's team? What is the market? What are the financials? And what are the potential red flags? You check off what you verify, score updates live. It gives you a clear assessment to help you find out if this is the right fit for your family. It takes about 20 minutes or less, and it could save you years of regret. Use it before you wire another dollar, because the questions you don't ask are the ones that cost you the most.
And if you think about it, we are players in the game. We didn't make the rules, we play by them. And so these are just rules. Apparently Congress thought it was important for our economy to make these rules, and we're just playing the game by the rules set by someone else. And so we are paying absolutely the amount of tax we're required to pay under the rules. And so I want us to make full advantage of the rules. There's no obligation that we leave a tip when we send in our tax bill. So don't leave money on the table under the rules.
Yeah, and it's something that I think it's a bit misleading when people say that they don't pay any tax at all, or their businesses or whatever. They might not pay any personal federal income tax, but their businesses like mine and yours, generate a lot of tax revenue through property tax, sales tax, employee tax, a lot of these other taxes that are paid because of the business. You match your employees and everything else. You might not pay any federal income tax, but those tax advantages are set up to incentivize people like yourself and myself to build, so that it's kind of a good social contract for people in the towns and stuff that we're investing in, so that we can build more, refurbish buildings in areas, and keep incentivize people to build and develop and create jobs and things like that, so that people can elevate their lifestyle. And that's something I always like to share with everyone, because it's not just trying to game the system or take advantage of the system.
No, I think you nailed it. Like, there was a reason why Congress set up these tax deductions, because what it inevitably does is lowers the cost of capital, which means people can take marginal projects and make them work because their tax expense line item has been reduced. And the economic benefit of that investment far outweighs that year's marginal reduction in taxes received. Because ultimately, to your point, like, we didn't not pay taxes. We've deferred when we're going to pay taxes, because we will pay that. Just might not be in year one. It might be in years later, but it doesn't go away. It's just deferred. And what that does allow us to do is take a project that had our tax rate been higher under the rules, we probably said that project doesn't work, but because our tax rate effective tax rate might have been lowered a little bit, all of a sudden that project works, and we're able to put 10, 20, 50, $100 million into the economy, and that has a significant amount of benefits.
Yeah, and you multiply that over the whole country, and a lot of other people are doing it, and rolling those projects into bigger and more projects just gets spread out more and more. Because because I know, this is just my opinion here, a lot of times, like, you see a lot of these projects where you have government housing, that's kind of a proven thing where they build it and it's a lot of cost overruns and everything else. As an entrepreneur, as a owner yourself, you have a fiduciary responsibility to your investors to provide a great product for the residents at a good price, because if not, then it doesn't work. Then you go out of business and the place becomes uninhabitable.
Yeah, I mean, I think that's a great point as well, is especially in our business, the multifamily business, you're like any other manufacturer of a good. You need to charge enough that you can get an adequate return on your risk capital, but you can't charge more than your customers can bear. And in this high inflation, high interest rate environment, that window between what your customers can afford and what the required rate of return is for the capital is really tight. There's no windfall profits in today's economy. It's very tight.
The margins are getting tighter and tighter just with all of things. Yep. You're seeing people are going to have to be, people like yourself that are very experienced are having to get very creative, and also, find, the devil in the details, where those little margins are. If you get a little bit of a break on the insurance, you get a little bit of a break where if you've restructured the property taxes or something over time, or you have but some other vendor fees that you're able to get a break on, or add some more amenities or some other things where you can bump up the price just a little bit because the market's a little bit better, because you're offering a better product than the other guys.
Yeah, in many respects, this is a business of pennies. And so it's a tight balance. And I think, good operators and good investors can strike the appropriate balance where they provide a great service and product for a price that their customers can afford. And it's one that produces adequate returns to get the banks and the investors to take the risks of financing those projects. And that's really where Bonaventure sits. Is we sit kind of in the middle there, where we are putting together projects, capitalizing them with lenders and equity co-investors, and we're producing a return that's consistent and predictable, but at the same time, we're producing housing that's desperately needed and at price points that our clients can afford. And it's a really thin business, but it is a very good business when you get it right, because we produce buildings that our clients love. We do surveys about them, and they really appreciate what they're getting, and they find a lot of value in it, especially in an environment where, the cost of a house has gone through the roof. The cost of the interest rates has gone up. The cost of insurance has gone up. The cost of real estate taxes have gone up. and they're like, wow, I would like to be a homeowner, but it's just too expensive. But this home that I'm now renting is a really good value, and thank goodness I have that opportunity. And so that's what we try to do every day.
Yeah, and that's one of the things that people that are operators that sometimes, especially newer operators, kind of forget. They get too spreadsheet intensive and look at all the numbers. But when you really boil down to the details, is that, happy residents equals happy property managers equals happy investors, because it's without the residents being happy, they won't stay. They'll go somewhere else where they're treated better. And it's still a people business. It's not, no matter how much software or AI you infuse into it, people are going to stay where they feel.
Yeah, and I think that what people value is on a continuum from, at the barest level, it's shelter, keep me out of the rain. But once you've got that satisfied, people really want to move up the scale towards community. And community is not about the physical building. It's about the programming of that building, the relationships with the staff, the programming where you create opportunities to meet your neighbors. And so we want to take the physical buildings and move them along that continuum to provide community. And that's really where the magic happens, because when you can connect people to the people that they live next to, connect them to the neighborhood they live in, that ultimately satisfies a much more higher level need, which is to feel part of something and connected once you've got your physical safety taken care of. And I think that's really an opportunity that a lot of property owners have, is they have a good building and they think the only way to upgrade it is by changing out the appliances from white to stainless steel or from mica to granite. And that's expensive. But what is less expensive and more valuable ultimately is, how do you provide that community and that connection? And that doesn't necessarily cost you a penny in terms of upgrades. It's just, how do you be more intentional about connecting your residents to each other and the community they live in? And then they're going to stay, because they're like, wow, I have roots here.
Yeah, building a community is really what it's all about. I mean, if people feel like they're a part of something.
Still guessing your next move. As an investor, most people have no idea where they actually stand. The Investor Readiness Scorecard changes that. In 5 South, just 10 minutes, score yourself across 5 critical categories: financial foundation, education, strategy, network, and action readiness. Instantly discover your investor phase and get your exact next move. No more guessing. No more spinning your wheels. Take the free assessment now at investwithscottkid.com.
Part of something, they're going to stay longer, and they're going to know their neighbors and everything else. And I think that's definitely something that shouldn't be lost in the details, because that's really where the happiness is.
Yeah, for sure.
Yeah. And what would you say is something that you all do to build this community, just for a tip for a younger audience out there that's maybe has a couple buildings?
Yeah. I mean, it's simple stuff. Like, we're big in coffee. So we always have coffee in the lobby because, and it's not inexpensive to provide good coffee every month. Like, it's a couple $100 in a 200 or 300 unit building. But what it does is it creates that opportunity for people to have those unplanned interactions, whether it's with their neighbor or with the staff. Because now imagine if you didn't have coffee, people are busy, they leave for work early, they come home late. And if they don't have a reason to bump into you, they're probably calling you when their toilet runs or something. And so it does not build the relationship around something positive. And so simply having coffee in the lobby gives an opportunity to build relationships, so that when their toilet runs, you get a lot more grace as the landlord when they're like, hey, and I'm not going to yell at them from my toilet running, because they handed me the creamer this morning and they're really cool. And you know what? They take good care of me, and I'm sure they'll have my toilet fixed by the time I get home from work. And so that is just a simple way to build community, is around coffee. But then, the programming can be super simple in terms of how you use your facility. You don't have to have a fancy facility. You can have a food truck show up on a Saturday. It doesn't cost you a penny. Pulls into the parking lot. You promote that with the residents. You literally spent nothing. The food truck provider is so excited because now they have a captive audience, and that's a treat for the residents to have a food truck pull in, and they get to meet their neighbors and so on. So like a lot of very inexpensive things you can do. It just requires commitment and education, or commitment and planning around some of these things.
That's a really great tip, because, I see a lot of people like, oh, we have to have a dog park, we have to have this, we have to have that, and all these amenities that generally cost money, and sometimes they end up being like a dead space, whereas you're talking about things that are a little more interactive. There was a community that I lived in at one time, and they had like a little social gathering where they had barbecues, and they had stuff by the pool, activities for the kids and stuff like that, where it would force people to go. And they actually went around and knocked on all the doors and said, hey, we're having this happening on this weekend, please come out, meet your neighbors, have some fun. And I think those things are great.
Yeah, and to your point, I've visited literally 1,000 properties in my time, like touring them. And I've been in the properties where it's the most beautiful clubhouse. And when I look at the financials, they're performing very poorly and no one ever uses the clubhouse. And then I've been on the properties that are older, have zero amenities, and they're crushing it. And the difference is all about the staff and the programming that they bring and that community that they build. And so I think that's where I would start. If you're trying to invest in your property, I would first start investing in building that community before you physically start spending tons of money on amenities.
Yeah, I would say, are you all vertically integrated, meaning you guys own the whole process? You have your own property management, construction, and everything else?
Yeah, so great question. Let me tell you a little bit about the businesses that we have, and they're all connected around providing those great outcomes for our investors and our residents. We have our investment management business that helps 500 families build for their future. We have a really interesting development business built around taking land that's owned by someone that wants to stay co-invested, and they put up the land, we take care of everything else, and we become partners and own those buildings for a long time. And that's been a business we've been in for 20 years, and it's really rewarding when you help a family continue the wealth generation of getting cash flow every month versus a piece of land that maybe was not producing anything. We have our property management business, Vest Residential. It manages for us and a handful of owners based in Charlotte. We have an internet service provider, which is probably the most exciting business because it helps all three sides. It's a better service for the residents than traditional monopoly incumbent like a Verizon or Cox or Comcast. It's much better for building operations and the property management staff because the service is integrated into the property management software. And of course, for the owners, because they're able to earn a portion of the revenue that was currently going to one of those monopolies, the residents just redirect it as part of their rent. And so it is a great business. And then the last one is an insurance business because we saw that we have no control over insurance and we're price takers. And that is one of our biggest line items. And we wanted to be able to exert more control over the long term.
That's brilliant because insurance can be tough. I mean, living in Florida.
Oh my gosh.
You're almost like you're really just at the mercy of whatever. And there was a brief moment where there was really only one or two providers, and they were basically roughly the same. And then you were looking at also Citizens, which is Florida, the state of Florida, which that was hit or miss. And especially when you get into commercial properties and stuff like that, it could be pretty tough. It drove a lot of people to out of the market and stuff. And what would you say is the market that you guys are the most invested in? Are you guys in the Virginia area in that DC Metro?
Yep, we're not DC Metro, but south of DC Metro down through Richmond and then east to the Virginia Beach, Norfolk area. Okay. And then we've got assets in the Carolinas and so on. But we're a secondary and markets kind of investor. We want to find those markets that have good economies. They don't have to be scorchers, have limited supply, because that's where we found that we can produce consistent returns. If you can produce consistent returns, then your risk is lower, which means you can actually do more projects because it's not as volatile, and that helps us to attract the banks and the investors. It also helps us to provide consistent housing. We don't have booms and busts, because the other side of the bust when rents drop is the boom that takes place because no one's built anything, and now you're having to raise rents to make up for the down cycle you just came through. And that's just it's not a great sustainable business. We want to own assets for a long period of time.
Yeah, that's a similar strategy to what we're doing in Texas on our development projects. We're in secondary markets south of Dallas because all the really large, hyper competitive stuff is on the northern side of Dallas, where they're building 500, 600, 700 units at a time, where ours is kind of a boutique, kind of infill stuff, 100 to 180, 200 units kind of thing, and then some small built-to-sell townhomes and stuff. So, along with our medical offices, they're kind of in the secondary markets and stuff, because the hot markets, like you're saying, are very competitive, and you don't have as much leeway with a lot of those properties. That's a really great strategy, and that's why you guys have been around for so long. And you're vertically integrated. You have a bunch of other revenue streams that support that whole business. This has been really great, and I really appreciate that you have come on and shared your whole story and really given us a lot of great tips. What's the best way for anyone to find you if they want to find out more about what you guys are working on?
Couple of things. One, go to bonaventure.com. That's our company website.
Blueprint, the passive investor due diligence checklist. You found a deal, the returns look great. But before you wire a single dollar, do you know what you're really investing in? Most passive investors skip the hard questions. No PPM review, no sponsor vetting, no exit strategy. They hope for the best. Blueprint fixes that. For pillars of protection, 87 plus vetting questions, a live scoring dashboard that gives you an instant verdict. Invest, caution, or avoid. Work through each tab. Note your red flags. Review your score. Decide with confidence, not gut feeling.
Website, lots of resources. You connect with our team, me. Follow us on LinkedIn. Connect with me on LinkedIn. We've got lots of resources. We're constantly publishing interesting pieces. So lots of ways to connect. And we are in the business of helping individuals build long-term wealth.
That's really great. Well, appreciate you coming on. Thank you so much.
Yeah, it's been great. Thank you.
Well, this is Scott Kidd, the Yacht Captain Investor. Just a reminder that the best investment you can make is the one you make in yourself. So invest heavily in you. See you guys next time.